Let me. All right, I have audio for you. You got three people. So I can do it two ways. I can do it this way, or I can connect you to the TV. It's up to you.
That way's fine, I think.
Perfect.
So
I will monitor all of your chat. But yeah, you are good to go.
Okay,
I'll be right back.
all right. Well, sounds good. Well, appreciate you joining me here today. The theme here, what they call non-QM world is like gaining market share constantly over the last probably 6-7 years. And if anyone doesn't know what a non-QM mortgage is, it's basically one that doesn't fit the boxes of regular conventional financing, which would be guidelines that are made by Fannie Mae and Freddie Mac, or the government agency, which is Ginnie Mae, and they provide all the guidelines for FHA, VA, and USDA loans, and even reverse mortgages, all the ones that are insured by the government in some manner. So non-QM products are ones designed that kind of don't go outside of the box of how lending's got. There used to be a lot of these types of programs back prior to the crash that happened in 2009, 2010, that sort of thing. And then when Dodd-Frank passed, pretty much just shut down the whole non-QM world for a while and made it to where it was just so much risk and stuff that investors and lenders just kind of got out. And some of the people that suffered the most from that, or the biggest percentage, were people that are self-employed or had income streams that were non-traditional, or not where not everything shows up on somebody's tax returns. So these products came out that kind of get outside that realm. They're all still really good loans, but it makes it so a lot more people, especially self-employed people, have options as far as buying a house. What a lot of people don't realize too with non-QM, there are a lot of full doc type programs where they might fit out of the box, they might slide out of the box because the debt ratio is too high, or maybe their last year's tax return showed enough income, but Fannie Mae, FHA, all those ones want a 2-year average on tax returns. there's ones where, there's products where you can just use what somebody's 1099 is for income. There's ones where, a real popular one's bank statement loan where they come up with the income that way. There's even loans where a CPA does a profit and loss, and they'll use that as an income figure, and they don't even have to provide their tax returns. So that's kind of where all these fall in. Some of the ones that are real popular that are the full doc ones is where the debt ratio goes over 50%. And that seems high to a lot of people. But there's a lot of times where maybe there's more income, but somebody might be married and their spouse doesn't have a real high credit score or something, but they still bring in a lot of income. So it still could be very affordable for the person. It just wouldn't look good on paper in the standard lending world. So we basically have what we call portfolio products that are all kind of around all the guidelines with these. So, and what portfolio means is we don't broker them out. We're not, we're different investors have different guidelines, but we're delegated. So we basically do them all in-house. So we use our appraisers, our underwriters, that sort of thing. So we have the same control over these as we do the conventional FHA, VA, all those types of loans as well. So it does open up, just knowing that these exist. I think if people just if agents have a basic understanding of what else available out there, they definitely could pick up more buyers or more clients throughout the course of a year. Hopefully at least several transactions or something, talking to people. Now, of these loans, there's one that I've personally done the most of that I think is probably the hottest of these products. It's a business purpose loan, so it's for investors or people wanting to buy an investment property, and they call it a DSCR loan. And what that stands for is debt service coverage ratio. So this is a no income program. Somebody just has to have a decent credit score, and we can make exceptions to those. I think the handout might say a minimum of 660, but it depends if it makes sense or not. But the underwriting's done on the potential cash flow of the property and has nothing to do. We don't even care where they work. We don't see tax returns, anything like that. We just have to show they have the money for the down payment, the reserves that are required. And then the appraiser goes out there and they do a rent schedule, and we use that. And as long as rental income is going to at least cover the payment, then that's how the loan gets approved. And those can be done on single families. They can be done on 2 units. We can do them in-house up to 4 units, but they on our commercial side, we can broker those, and they're basically underwritten the same way and can do those up to 100-unit apartment buildings.
Question.
Yeah.
Just from somebody that has a lot of investors. Now, when it comes to, because like my last deal that I had, we had a 4-unit and we had to go commercial. And it was just because the property itself was commercial. Now, do you have it to where it's 4 and under is residential, 5 and above is commercial in regards to lending?
Yeah.
Okay.
And it doesn't matter to us if a property's zoned commercial. I know the previous lender I worked for, like if something was zoned commercial, and we were done. We couldn't do a loan on it. We can do them as long as the appraiser states that the highest and best use of the property is residential.
Gotcha.
So if say it was a 4-unit and one of them had like a business in it or something like that, or it was just a property that has since been, initially switched over to where they zoned it commercial and they're built commercial buildings around it. I mean, as long as the best use of that property is for people to live in it, then we could use this product for that.
Good to know.
We can even do that for regular Fannie Mae and Freddie Mac loans too. So we'll kind of use the appraiser's best judgment if it's best used as a home that for people to live in.
Got it.
Let's see. I mean, people can do refinances and stuff under all these programs as well. Sometimes investors might own a bunch of properties. They can get cash out of several to pay cash for a new one, or just get the down payment for a new one that they want to buy or add to their portfolio. It's also the only type of loan that actually can get deeded right into an LLC right at closing. A lot of investors have to buy the house in their personal name, and then even though there is a clause in the mortgage that says you can't do this, it's a regular practice. People do, they'll quit claim it into their LLC after it closes. So that's something that a lot of investors like, just because it's more convenient for them, and they can keep it under their LLC umbrella where it's protected and stuff. That is probably my most favorite of all these products, and the one that we do the most of as well. Let's see, what else can I think about? I mean, that's the basic of it. As far as qualifying goes, like somebody can't be they can be a first-time investor, but they can't have never owned a home before. They have to have at least had some sort of property for 2 years that they could document at some point in their history. And it could have even been 20 years ago, but they just have to have owned at least one home before. So that's one of the funny things that comes up with that. But there's not really much that can go wrong on them as long as once they start, other than if the house doesn't appraise or something like that.
Gotcha.
Did you have a question?
Yeah, so Brad, you're telling me that as long as you owned a house, like using us as realtors, if we owned a house and we wanted to buy an investment property again,
Mhm.
if we owned a house already, we could purchase
Yeah,
as
as long
an
as-
investment with, where you don't look at our docs or anything.
right.
Okay.
And you just would need to have 20% down and then at least 6 payments in reserve somewhere. And that could be, 401k or, any type of account. So if the payment was $1,500, you'd have to have the 20% down plus at least $9,000 left over.
So can I ask you, would that be something that you could handle, like say if you wanted to buy a house in Florida, like
Oh, yeah.
if I wanted to buy a retirement home in Florida, and that would be, you can do loans down there?
Now as long as you were gonna rent it, you do have to sign something that you are gonna use it as an investment property. There are some products for like second homes and stuff, but they would fall outside of like these easier guidelines as far as the underwrite goes. That doesn't mean that at some point down the road you couldn't live there, but you would have to initially plan to use it as an investment property.
Do you know how long you have to have it as an investment property, so many X amount of years, or?
I don't think there's any specific guidelines on that. And that did make me think about a couple things that I've heard of can be problems with those. You'd have to get a special exception if it's like what they call a border house. So if they're renting out individual rooms in a building, those get real tricky. You might have to get into the commercial side of things with that. But yeah, but other than that, like you could, as long as you rented it out or planned on renting it out for a year or two and eventually wanted to use it as your second home once you retire or something like that, yeah, you could use this for that.
Cool. Or if we know somebody that wants to move to Florida, that's something you could help them with?
Oh, yeah.
Yeah, awesome.
Yeah, my branch and I'm licensed in Florida, so I do loans in Florida when they come up.
What other states are you licensed in?
Right now, those are the only two,
Okay,
but if I have a reason to get licensed in another state, it just takes a couple weeks. I would just have to pay for the license for my branch, which takes a couple weeks for that to come through. But once the branch license is in effect, I would just have to pay the charge, take any continuing education that the state required. And then I could have temporary authority to originate a loan there. So I've looked into it. There are a couple states that I'm kind of like ready to go if I ever needed it, but it's kind of, I'm doing it methodically.
Cool.
But I can be involved in a loan, even if I don't get licensed in that. They call it a designated loan officer. And if somebody applies through my portal for a state that I don't have a license in, it automatically will send an alert. It goes to a desk. They'll assign a loan officer that is licensed. I talk to them about the conversations had with the client and stuff. They just have to, with the licensing laws, I'm not allowed to send them numbers or tell them about their interest rate or anything until I have the license or what they call temporary authority in the state. But it's almost just like I'm doing the loan from there. I'm the main point of contact. I get, notified of everything going on in the deal. So pretty much can do loans in all 50 states. And while I'm on the DSCR, I'll get into the commercial buildings also. Sometimes, a lot of realtors have never done commercial loans, or they might just run into them occasionally. But we do have some good outlets for basic commercial loans, like this DSCR is used if anything's 5 units or more. It's the same program guidelines and stuff. The rates are a little higher on commercial loans and the laws work a little bit differently. But where this also is helpful are just standalone buildings where somebody might be buying it to put a store in, or even like if they got their real estate broker's license and they wanted their own building or something, could buy it using these commercial loans. And it's same sort of thing. It's equity based, no tax returns, income documents, anything like that. It's all about having a high enough credit score and having the money to put down. And those standalone type buildings or unique buildings are 30% down, where you get above 4 units and it's 25% down. But those are pretty easy to do too, and can get answers and pre-approvals real quickly on those as well. Okay, probably the second most common non-QM loan is what we call a bank statement loan. These are definitely designed for people that have a business or people that are self-employed. Can be personal bank statements or business, but the easier way to do it is if somebody has business bank statements. And basically we get either 12 or 24 months worth. I personally like the 12-month just because it's easier. Slightly better pricing if you do 24 months, but it's almost not even noticeable. And what they do is take the average deposits over a year period, 12-month period. They take all the deposits, divide it by 12, and then the easiest calculation method is just whatever 50% of that is, that's what we can use as an income figure for qualifying. And then that's kind of everything else is similar to a full doc type loan, but that's where we get the income from, just from the bank statement.
Would you be able to use like anybody that say is retired after working many years and they have like a Roth IRA or something like that? Would they be able to use that as income to purchase another home?
That is another one of these products that's available.
Okay.
That's called a asset depletion loan.
Okay.
And basically, that one's real simple. Whatever those accounts add up to, divide it by 72, and that's the income that we can use for qualifying.
Why 72? Yes.
That's just what the investors for these ones that fit outside of the box came up with as far as income calculation.
So it'd be the income that they would have in the Roth RIA divided by 72 would give you the amount that you can use. Am I
Yeah,
understanding that right?
No, it wouldn't be the income,
Okay.
because we could use like Roth IRA income just on regular Fannie Mae, Freddie Mac conventional financing.
Okay.
You also can do asset depletion with that, but somebody has to be at least 62 years old, be putting 20% down, and they divide it by 200 240, like over 20 years. These ones are just whatever somebody's balances are in all their accounts. They could be in money markets, could be in retirement accounts, could be in Roths or traditional IRAs, whatever their net worth assets that they're listing show, we can divide that by 72. And then that, so say someone had $1 million, which would be kind of a lot, we'd use 7,200 a month for qualifying for the loan.
Okay, I got it, thank you. for that.
And that one's pretty easy to do too, I mean, because that's pretty much it, showing all the assets. And then that can be used in conjunction if they do have some income too. Like say they get Social Security, but it's only $3,000 a month and they want to buy a $400,000 or $500,000 house, they need more than that to qualify for that. If they've got money in their retirement accounts, and we can use that to kind of bridge the gap, so there's enough income to qualify.
Okay, great, that's a great information.
Yeah, and probably out of all these products available, I personally have done DSCR the most, probably 4 times as any other of the program, but I have used this bank statement program, probably 10 times in the last 3 or 4 years, so that one does come in handy, and it's more for if it's somebody buying a house they want to live in.
Okay.
But you can't do them on investment either, but since there is that DSCR program, there's no reason to use it, because the DSCR is so much easier.
Okay.
Now, another thing with the pricing on these loans, the rates are a little higher than what the standard, conventional loan rates would be.
Okay.
However, most states allow for prepayment penalties. Ohio doesn't. They really restrict the prepayment penalties, like the state itself has its own law on that. But if somebody was buying in Florida, if they were willing to take a 5-year prepayment penalty, the rates are basically the same as they get if they were, doing a regular conventional loan. They're a little higher. If not, Ohio's law is, for some reason, the loan amount has to be over 112,000 change, and it has to be an investment property, and then they can charge a 1% prepayment penalty, get you a little break on the rate. Now, if it's a 3 or 4 unit, they do allow that 5-year prepayment penalty on investment properties, but those just don't come up as often where people are buying, more than the 2 units. But those are the only ones where in Ohio it's allowed. But the difference in rates probably 1.5%, so a lot of people are fine with it. And it's not, you can do like a 1-year prepayment, 2-year 3 all the way up. And say they did the 5-year, like most commercial loans have a prepayment penalty. And the way a 5-year one works is like if they paid it off in the first year, they'd pay a 5% penalty. Second year be 4, third year 3, fourth year 2, fifth year 1, and then it goes away. They could pay it off anytime. So it kind of scales down as it goes. Any questions on those so far?
No, that's it.
Okay, then we have some of the full doc programs that fall into non-QM. And actually some of these, like Fannie Mae and Freddie Mac 4 or 5 years ago, used to be if somebody was buying a second home, they got the same rate as if they were going to live there. And 4 or 5 years ago, for some reason, they wanted to scale off their balance sheets, investment properties, and second homes. So they put like what they call these loan level price adjustments in the pricing, and they're big, like it's 4.5 points. And right now, the way the bond market's been so thin since the rates have been rising, because the market itself doesn't think the loans are going to be on the books that long, so they're not willing to pay the premiums that are typically there in our world. But they made the second homes just as bad as the investment properties unless someone's putting a huge down payment down. So these non-QM loans don't do that. They don't have hit for second homes. And they do allow for that 10% down. So sometimes it's better if somebody's buying a second home to just do it under a non-QM program rather than one of the agencies, which would be Fannie Mae or Freddie Mac. The ones that go over 50% debt ratio, like going from 50% to 55%, you know, a lot of times that's 80, 100,000 difference in price. So sometimes that really comes in handy because they allow for those higher debt ratios. FHA also will go, if it likes a loan, it can go as high as, it doesn't start not approving it until 57% debt ratio, but there are some listings out there or properties that won't accept an FHA offer, or sometimes if you're competing or something, you know, they'll just throw the FHA one aside if there's conventional ones that are comparable. So this could be a solution for somebody like that, you know, just needs that higher debt ratio to qualify. Can do them on the condos that aren't warrantable. For some reason, they don't meet all Fannie Mae's guidelines. You know, you can use these full doc loans for those as well. We still would have to look at it and make sure it's not something major that would be like a huge risk, but most of the issues that come up that make condos non-warrantable, there's options to do it in the non-QM world. Oh, they have shorter seasonings if somebody had major housing events or personal events like bankruptcies or foreclosures, things like that. You can do them 1 day out, a year out, things like, you know, they're so if someone's scenario makes sense, pretty much all these loans, like other than the DACR, you need at least 20% down. All the other products are as little as 10% down, but that's pretty much the minimum down payment on anything right now on the non-QM side of things. Yeah, and credit scores in as a general rule of thumb 660, but there are, you know, some things where we can get like pretty big exceptions to those if it makes sense. And another thing with non-QM loans, other than the DSCR, because, you know, unless there's some weird thing about it,
Yeah.
they kind of get processed backwards. Like we get them underwritten before we even do the pre-approval letter, just so that part's all done. You know, so it's, but it does make them, they go just as fast as any other type of loan would go. And occasionally they rate the appraisals on these, and if appraisals, when they come in, have a score that the computer just kind of gives it as the house solid of an appraisal it is, I guess. And if it drops below a certain score, we have to have this extra review done. It's like a desk review. Another appraiser doesn't have to go out, but another appraiser reviews all the data and stuff and make sure they agree with the report or are in the same area as far as the value goes. Any of the ones I've had that we've needed that, it's never caused an issue with file. It's just, we just don't know if that's gonna be required until the appraisal gets turned in.
How are the appraisals going right now? Are most houses appraising for purchase price, or have we had any issues?
Most are, I mean, I'm hearing that I've had a couple appraisals come in short. But the one that I know of, the buyer and the realtor kind of expected it to, just because it was so nice compared to the rest of the neighborhood. And then I had a 4-unit one, and I think it was just, we got a bum appraiser that time. I think it would have appraised if a different appraiser got it, but. And they, the way we do it, we have what we call a panel. So in the primary market, which is basically Stark County and all the surrounding counties around Stark, you know, like one or two counties out, depending which way you go. We have appraisers that I've known for years, been working with for years, they're on this panel, so. I'm not allowed to pick because of the laws what appraiser gets an order, but all the ones on my panel, I know are. You know, good, I know they're not gonna be, I know they're from the area, they know the market. You know, they rarely have issues on the appraisal unless they can't find comps, and then. You know, usually it's something that can be solved. The county where we have, that's around here. That. Just a lot of the appraisers don't like, so it just takes a little longer for us to get the appraisals back, or is in Carroll County. Sometimes it might take a couple weeks to get an appraisal back there, but otherwise they should be. On the phone a day or two after it's ordered to get it scheduled and stuff, so the turnaround's real good. But a lot of lenders use what they call AMCs, which I have to do that if I do a loan in Columbus or. Cincinnati, and for some reason, those two cities have just continued to use AMCs. You know, which usually aren't bad, you just never know what you're getting, it's just kind of luck of the draw there. I talked a little bit about the asset related programs, that asset depletion. And she had, I think, I don't think you were here when she asked a question about these, so I started talking about them a little bit. But if someone doesn't have any income, but they have a lot of assets, or maybe they're retired and they only get social security and it's not enough to qualify, but they have plenty of money where they could easily afford it. If they're not willing to, if somebody's of retirement age, usually it's an easy fix. We can just set up a draw for whatever amount and they can qualify normally. But if for some reason they don't want to do that, or they're under retirement age, they have these asset depletion loans where whatever their portfolio of investments adds up to, divided by 72, and that's the income that we can use for qualifying. And those are, I've done a couple of those. I think they're a little more common in some of the higher priced markets in the country, like the East Coast and West Coast, and you know, certain areas in Florida and stuff, but those are real common there. As a company, they showed what percentage of all these are getting done. I think the DSCRs was the number one, but close behind that was that high ratio one where you can go up to 55% and still do a conventional financing. You know, and then the bank statement and the asset depletion ones were about even. Some of these other get in what they call the alt doc ones. And these are all kind of designed for self-employed people too, and where they plan on living in the property. There's the if somebody's like was a W-2 employee, say, and they just a year ago switched to 1099. You know, normally you'd have to wait for 2 years of tax returns for them to be able to qualify, you know, conventionally or even the government loans. VA sometimes will make an exception to that and use the most recent years, but you know, they could fall into this, and they basically will just use the 1099s for the income without waiting to see what they write off and that sort of thing. Same thing, just need the 10% down at least in the 660 score.
So just to clarify that, Brad, self-employed 1099 income, they don't need to have that for 2 years?
Right,
Okay,
on these all doc ones, it would just be for 1 year.
1 year, okay.
And that's some that, if you run into someone like that, I know a lot of agents that have been doing it for a while. Just know when they're just having that initial conversation, getting to know who the potential client is, stuff, if that comes out, they might even tell them that they're probably gonna have to do that for 2 years. But with all these gaining popularity and stuff out there, it never hurts to see if they might qualify for something like this. Sometimes people are real surprised. kind of in line with that is the profit and loss. That's if they don't get 1099s. You know, maybe they get, their sales are cash or, you know, smaller amounts that they're doing business on the internet or something like that, to where they're not gonna show 1099 income. That's where, as long as a CPA does an audited profit and loss statement, can use that for income, and it would just be for the most recent year. And so those are ones that just are kind of outside of the box where, you know, 6, 7 years ago, somebody wouldn't have a chance, they'd have to wait. You know, that now there's kind of a slew of things, and, you know, and it's all common sense underwriting. They don't want to put someone in a loan they're not gonna be able to pay back, so that's why I think that the least you can put down on these is 10%. You know, but they look at the whole picture, if they make sense and fit the box. A lot of these loans they've been making have a really low default rate, you know, foreclosure rate, because they make sense that someone's gonna be able to make the payments on them. And I think the industry even understands that it's a catch-22 for people that are self-employed, you know, with what they put on their taxes. I mean, if you claim an extra 20, 30 grand in income, it's a pretty big chunk more that you gotta give to the IRS. So I think when Dodd-Frank came out, they kind of got in cahoots with the government, the IRS, and wanted to try to force people to be claiming more income so they could collect more taxes. But because prior to that crash, there were all kinds of Fannie Mae and Freddie Mac programs that were kind of for self-employed people, like the no ratio ones, and there was one called Fast and Easy 95. They put 5% down, you had a good credit score, it would just be a stated income. You know, there were probably too many of those, and that's one of the things that kind of contributed to the crash, where everyone saw their house values drop and, you know, kind of put the country into a recession. So they don't want that to happen again. But so far, these loans have such a good performance rate that they're actually expanding, like more programs keep coming out, you know, kind of as they go, and what might make sense to the investors. A lot of mortgage bonds just end up in various investments throughout, you know, people's retirement plans, you know, different mutual funds. A lot of overseas people, you know, clients that will invest in, you know, investments that are backed by mortgages, and it just all depends how they perform, what their return is. But it's typically higher than what you'd get on like a CD or a money market or something like that. And we're gonna see those rates. You know, people have been able to get 4 or 5%, which if you have money, that's been nice for, you know, the past 3 or 4 years. But the Fed cut rates yesterday, didn't really help mortgage rates, but I think the bond market's settling back down. And that happens a lot because the mortgage market kind of anticipates what the Fed's gonna do. And if there's no surprises, the rates have already came down, just kind of knowing what they're probably gonna do. And it looks like from what they said from the meeting, they're more than likely gonna make 2 more cuts before the end of the year. So I think that will, you know, equate to lower rates. I'm hoping we can get like the average rates for conventional loans, that sort of thing, closer to 6%. Right now, they're just mid sixes, you know, 6 3/8, 6.5, you know, depending on what somebody's credit score is. A lot better than they were. But I do think it's gonna be a real boost to the market once we get at 6% or even slightly below. So hopefully we get there soon. If the Fed does cut, you know, another 50 basis points before the end of the year, we should be close to 6%, I think, if they do that. Right now, there's the majority that's what they want, that are on the Fed committee. I think it's 9 of the 16 want 2 more cuts. I think there were 2 that don't want any more cuts, and 1 that wants to raise them. You know, that's not gonna happen. Then there was 1 that wants like 1.5% cuts by the end of the year, but that's probably not gonna happen either.
No, that seems a little too wild.
Right. Yeah, but I think that's probably what we'll expect. We'll see like with maybe a couple bumps in the road when those inflation reports come out, or like if there's a surprise jobs report or something like that. Might see a short spike up, but I think we're gonna see like gradual decreases here the rest of the year. This last product, I personally haven't ran into this much. I think I may have talked to two people that wanted to look into this. But there are some areas in the country where this is pretty popular. They're called ITIN programs. So that's basically for someone who's a foreign national. They file taxes in the US, but they don't have a social security number or anything like that. They just have a ITIN number. And as long as they have a credit score, that's the issue I've ran in a couple times. I've looked into people, they just haven't opened up any credit in the US. But as long as if they do have a credit score, they can be approved for whatever income they're claiming, even though they don't have a social security number. They cap those a little bit, and it's minimum 20% down, but if somebody's in that boat, it's worth checking into it, or can tell them what they need to do to get a credit score. And I think we have a couple broker outlets that don't care if they have a credit score. But I only do the brokered loans. One, it's commercial, it's the only way I can, but those are much easier. But the other one, we just don't have the control, so we gotta, if I'm acting as a broker, we gotta use their appraisals, their process, their system, their underwriter, that sort of thing, and that makes me nervous. It's not that I would never do it if everything made sense to me. I just don't, I like keeping the stuff in where I like have the direct involvement and control.
Oh, yeah.
So that's most everything that's out there. I mean, the caps are real high. We don't run into many homes, that are more than 2.5, 3 million, where that someone would need a loan for that much. I mean, there are some out there, but a lot of times people buying those homes have better options. Like usually they have a financial advisor and they've got a lot of assets, and they actually will offer they'll like hedge against their assets and be able to give them a rate that's 1.5% lower than what the rest of the market is. So but those $1 million houses, 1.5 million and stuff, we do run into those occasionally, and those are sometimes they can use these types of programs, sometimes they're good enough just for the regular jumbos. We do those same day mortgages if someone's just a conventional borrower or jumbo. We do them on jumbos too. They basically, it doesn't even get turned into my team for processing. It just goes right to the underwriter. The underwriter reaches out to the client, tells them everything they need, answers questions, and they try to have the full underwriting approval in a day or two. So jumbos always require appraisals, where a lot of just regular conventional ones get the appraisal waiver if someone's putting 10% or more down. And then if someone's refinancing, there's even a lot more appraisal waivers if someone's refinancing, if they've got, the equity. I'm seeing a lot of that. There's a lot of people out there that bought in the last few years, so that homes have went up a lot in value. I just looked at one of my former clients, he bought the end of 2023. It was in December of 2023, so it hasn't even been 2 years, and it's just let's see, where is that? It's close by here. I think it's out in Alliance, but he paid 170 for it, and I just plugged in 2.25 and gave me the appraisal waiver. So they gained 65,000 in equity. just in
Right.
2 years, so bought at a really good time. And even ones that people bought a year ago, I think they'd be surprised how much the houses have went up in value. I think that's slowing down a little bit right now.
Mhm.
The market's it's been a weird market all year. But
Right.
there's business out there, it's just kind of, and I don't even know if there's even such thing as a normal market anymore.
No.
Every year is kind of its own animal. Is there, does anyone have any other questions or anything?
I don't think so. I don't have any on Zoom. All of our people are still there.
Well, cool. I appreciate everyone taking the time. Anyone has any questions, even if you got a deal going or something like that, I'd be more than willing to help, even if it's not something I'm directly involved in. I've been doing a long
What's your
time.
process? Like, say if a buyer, wants to talk to you about a pre-approval, is that something you send via email and they have to fill it out, or do you take the information over the phone, or what's your?
I mean, sometimes I talk to them, it depends what they want. Sometimes the agents will just send them a link to my website or my app or something.
Okay.
And it's a super easy it takes like 10 minutes to fill out their information on the digital mortgage. And if they do that, it's really quick. And we've been using like our own AI platform for years now, and some of the other banks and stuff are just kind of in the infant stages of getting that set up in their platform. But there's things that run in the background, like if somebody clicks to initiate their employment verification, and they can do assets too, it'll ask them if they want to do that. But it'll pull up the information that's available on like the work numbers that are out there. There's like True Work, there's one called The Work Number. And if the system can pull like their W-2 information, their year-to-date information, that sort of thing, it validates it right there. Sometimes we don't need any pay stubs or anything. It's
What
already.
is your app? So it's an app that I can share with potential customers that wanna get pre-approved, I would refer them to your app.
Yeah,
And what is your app?
my website's just Brad Campbell. Like if you Google
Brett, oh,
Brett
I see it
Campbell,
here,
right?
Brett, okay, I see it now, okay, great,
Yeah.
Brett.
Or I can like share my app from my phone too, that could be shared as well. A lot of times if somebody calls me, I talk to them and kind of get the basics, and I always let people know too, if they contact me first. Sometimes people they're real to tell them to fill it out, and I just see it come over, because I get notified if somebody starts and when they finish.
Okay.
And then once they finish, it's pushed to my system and everything's there. I go and review it and then reach out and talk to the client about it. But if they call, I kind of get the basics of what they're looking for. I find out if there's first time home buyer, and where they're comfortable payment wise and that sort of thing. So it just kind of whatever's easiest for the agents and what their clients are comfortable with. Or we can meet in person too. At first, because I used to meet with everyone when I took their loan application, and I mean, I do take information for pre-approvals over the phone. But, so when I first came to this sort of setup, I was a little nervous about not having all that face-to-face time, but I found that people just love the convenience of it. They don't have to take a couple hours a day to come to the office. Even signing the application, like they sign everything, you can do everything right from your phone. Even close, like we can do the full e-closes, and I almost always do the hybrids, where it gets rid of half of the physical paperwork at closing, and they can just do it on their phone or computer. But the whole system kind of works like that. So once they apply, and it's just one question at a time, it's all, nothing real difficult on there. If you ever wanted to see kind of what the flow of it is, you always could just start applying, and then when you get towards the end where it asks for your social security and that sort of thing, it'll have you set up a password. Stop there, because that's the last step. But you can kind of see how the flow is and how easy it is. And a lot of times, just right when I'm talking to somebody on the phone, I'll copy the link to my website and just tell them I'll send it to them as soon as we hang up. As soon as we hang up, I just text them a link to the website and they start applying.
I like it.
Make it pretty easy.
Oh, yeah. And that's what we need, considering just how busy life is for every single person on this earth, like. In order to be able to get things accomplished, like it has to be those quick turnarounds. So, yeah, I like it.
Yeah.
And the system just does a soft credit pull too. So it doesn't affect them at all to get fully, same exact credit report as did the hard pull. It's still all 3 scores, same thing I'd get. We did the hard, we just don't do the hard inquiry initially unless, say somebody needed down payment assistance, the best place to do it was OFA, and they needed a 650 and they're at a 651. Let's say, hey, do you want me to do the hard pull right now? Then it's good for 120 days if they plan on buying soon. That way we wouldn't have a chance of losing the score.
Right, that makes sense.
And then say somebody's just a little off. So another thing that's really nice about the soft pulls, can run a credit simulator on them. See what it takes to get their score to a certain point. Like when we pull it at the end of our credit report, it'll show what their score is for each one and what it could potentially be. You know, so I have a general idea just looking at the credit report, but then say they only got $1,000 to work with, I can import it into the simulator and it'll let me know if there's any actions they can do for 1,000 or less to get their score where it needs to be. And it's pretty easy. It doesn't take very long either. Then if we have to do a rapid rescore, like say somebody wants a house, it's still on the market, they don't quite qualify and they're watching it every day, making sure there's no offers coming in or something. I mean, they can do that in probably a week if they got on it right away.
Okay.
So it just varies. And then some people they need to be on a 3 or 6 month plan or need to wait till next year. And most of the time most people kind of know that
Right.
initially that they probably have some work to do, but it's no problem at all for us to look into what they'd have to do, kind of give them direction and just be available for them. And so I have a sales assistant too, that like if I'm busy or if I'm doing something like this, if anything comes in, she'll reach out to the client and get any questions answered and that sort of thing. And she just kind of helps me.
All right,
Good, cool.
I like it.
Yeah, me too.
But yeah, well, I appreciate your guys' time today.
Yes,
Thank you,
absolutely.
Brad.
Thank you, Zoom.